Hey everyone, welcome back to Corporate Decoder, the place where we make sense of corporate jargon for you. And today's report from Two Roads Shared Trust, officially titled Form N-CSR, is a bit of a spicy one, hinting at corrections and deep dives into fund performance. We're going to decode what this amended filing really means for investors and unpack the financial story of the Enfield Dynamic Fixed Income ETF. So, what is this document all about? Think of it as a regular checkup for investment funds. This particular filing is an amendment, meaning they're going back to fix something in a previous report. Specifically, it is about correcting the date of an auditor's report, a small but important detail to get right. But more importantly, it points us to a treasure trove of information about how the Enfield Dynamic Fixed Income Fund ETF has been doing financially. This report covers the period from the 1st of August 2024 to the 31st of July 2025. It is basically a detailed report card for the fund, telling us about its performance and financial health. Let's talk about money. For every hypothetical $10,000 invested, the costs associated with holding the Enfield Dynamic Fixed Income ETF were about $151. That is 1.50% of the investment, essentially the price you pay for the fund managers to manage your money. It is a pretty standard fee for actively managed funds. But it is always good to keep an eye on these operating costs. Now, for the performance, the Enfield Dynamic Fixed Income ETF had a return of 4.23% for the last 12 months. However, it underperformed its benchmark index by about 1.85%. This underperformance is attributed to the fund being underweight in treasuries, which rallied because investors were seeking safety amid stock market volatility. Also, the fund's investment in securitized products like CLOS didn't do as well as the broader market. The managers are still optimistic about the economy, mentioning strong corporate earnings and consumer resilience. They feel comfortable with their current investment strategy, favoring credit risk over duration. Let's look at the long-term picture. This table shows how a $10,000 investment would have grown or shrunk since the fund's inception on the 17th of August 2020. On the 17th of August 2020, $10,000 was the starting point for both the fund and its Bloomberg US Aggregate Bond Index benchmark. Fast forward to the 31st of July 2021, our $10,000 investment was worth about $9,847, while the benchmark was at $10,002, a slight underperformance. By the 31st of July 2022, that $10,000 had dropped to $8,890, a significant hit, with the benchmark at $9,091. The trend continued to the 31st of July 2023, where the investment was down to $8,829, slightly worse than the benchmark at $8,784. Things started to look up by the 31st of July 2024, with the investment reaching $9,262, outperforming the benchmark of $9,233. And now, as of the 31st of July 2025, our initial $10,000 investment is valued at $9,438, while the benchmark is at $9,545. So, still a bit behind the benchmark over the long haul. Looking at average annual returns for the past year, the Enfield Dynamic Fixed Income ETF only returned 1.90%. Compare that to the Bloomberg US Aggregate Bond Index at 3.38% and the Bloomberg US Intermediate Aggregate Bond Index at 4.25%. It is clear the fund lagged significantly over the last year. Since its inception on the 17th of August 2020, the fund has actually lost value, showing a negative 1.16% return. The benchmarks, while not spectacular, are closer to breaking even or slightly positive. This really highlights the challenges the fund has faced. Let's glance at some key metrics. The fund has about $47.5 million in net assets. It holds only 7 portfolio holdings, which is quite concentrated. The advisory fee, the cost of managing the fund, amounted to about $367,402. Portfolio turnover, how often the fund buys and sells its holdings, is at 34%, which suggests moderate trading activity. Interestingly, 100% of the fund's investments are in exchange traded funds. This means it is essentially a fund that invests in other funds, a strategy called a fund of funds. The fund is heavily weighted towards fixed income at 99.9% of its net assets. This confirms its strategy of primarily investing in debt securities. The fund's top holdings reveal where it is putting its money. The iShares US Treasury Bond ETF makes up a significant 24.5%. Other major holdings include investment-grade corporate bonds, mortgage-backed securities ETFs, and Treasury bond ETFs. It also has notable investments in Janus Henderson AAA CLO ATF and Janus Henderson BBB CLO ATF, which are types of collateralized loan obligations. This shows a diversified approach within the fixed income space. Diving deeper into the schedule of investments, we see the specific ETFs it holds. For instance, the iShares 7 to 10 year Treasury Bond ETF is valued at over $6.5 million, and the iShares iBoxx X Dollar Investment Grade Corporate Bond ETF is valued at over $8.5 million. The total value of its exchange traded fund holdings is close to $47.5 million, matching its net assets with stated costs of over $49 million. Also, there are about $23,924 in other assets in excess of liabilities. Here is a snapshot of the fund's financial position on the 31st of July 2025. The investment securities are valued at fair value at $47.5 million, which is less than their cost of $49.2 million. This difference mainly represents unrealized depreciation, meaning the market value is currently lower than what they paid. Liabilities are fairly small, around $65,207. Net assets stand at $47.5 million. The net asset value per share is $8.49. Looking at the statement of operations for the year ended the 31st of July 2025, the fund earned about $2.1 million in investment income, primarily dividends expenses, including advisory fees, administrative, legal, and audit fees, totaled around $553,860. After accounting for some waived fees being recaptured, the net expenses were about $689,019. This resulted in a net investment income of about $1.4 million. However, the fund also experienced a net realized and unrealized loss on investments of about $524,069. All in all, the net increase in net assets from operations for the year was approximately $886,608. This statement shows how the fund's net assets changed over 2 years. For the year ended the 31st of July 2025, the fund saw a significant increase in net assets of about $3.4 million, driven largely by proceeds from shares sold, which were around $5.1 million, much higher than payments for shares redeemed, which were about $1.05 million. This indicates strong investor demand for the fund's shares during this period. This section provides per share data and ratios. For the year ended the 31st of July 2025, the net asset value started at $8.61 and ended at $8.49. The total return for this year was 1.90%, which, as we saw earlier, lagged behind its benchmarks. The ratio of net expenses to average net assets is 1.50%. Reflecting the cost of managing the fund, and the portfolio turnover rate for the year was 34%. One organization, the fund is a series of shares of beneficial interest in the Two Roads Shared Trust, organized in Delaware. It is an open-end management investment company and an actively managed exchange traded fund. Its investment objective is to seek total return with capital preservation as a secondary goal. To significant accounting policies, this is where they explain their accounting methods. They follow generally accepted accounting principles in the US. The fund is considered a single operating segment, meaning its entire business is managed and assessed as one unit. They value their securities using market quotations for publicly traded ones and fair value for others. To security valuation for exchange, traded funds, they use the last quoted sale price. For others, they use fair value procedures approved by the Board of Trustees. The advisor is the designated party for fair value determinations. To exchange-traded funds, they're invested in ETFs which trade like stocks but represent a basket of securities. The risks are similar to owning the underlying investments, but liquidity can also be a factor. 7 principal investment risks. This is a crucial section. It lists all the potential downsides of investing in this fund. We're talking about risks like active trading, authorized participant concentration, bank loan risk, cash redemption risk, collateralized loan obligations risk, common stock risk, and really a whole alphabet soup of potential problems. They mention fixed income securities risk, which is sensitive to interest rate changes, and high yield risk, which comes from investing in lower rated debt. There is also market risk that the overall markets could go down, and volatility risk because prices can swing wildly. This table shows the fund's financial performance over 2 years. For the year ended the 31st of July 2025, the fund had a net investment income of about $1.4 million. It also had a net realized loss from investments of $5,984 and a net change in unrealized depreciation of over $531,000. Despite these losses, the fund saw a substantial increase in net assets from share activity, with over $5 million in proceeds from shares sold compared to about $1 million in redemptions. This resulted in a total increase in net assets of over $3.4 million for the year. This is the auditor's report. Deloitte and Touch LLP has audited the financial statements and highlights. They state that the financials present fairly in all material respects, the financial position and performance of the fund. They conducted their audits according to standards set by the Public Company Accounting Oversight Board. The auditor's opinion date is the 29th of September, 2025. This part details the board's review and approval of the investment advisory and sub-advisory agreements. They considered the quality and extent of services, personnel, business practices, fee comparisons, and profitability. They noted that while the fund underperformed its benchmark and peer group over certain periods, they considered the discussions with management and factors contributing to the underperformance, along with recent improvements. They concluded that the advisory fees were not unreasonable. Now, let's put on our Warren Buffett hat and look at the big picture. The N-Field Dynamic Fixed Income ETF is essentially a fund of funds focusing entirely on fixed income, specifically through ETFs its performance over the last year, and since inception has been frankly disappointing compared to its benchmarks. The fund has struggled to keep pace, and in the long run. An initial $10,000 investment has actually lost value. On the positive side, investor sentiment appears to have been strong recently, with a significant increase in share sales compared to redemptions in the last fiscal year. This suggests that despite the underperformance, investors are still buying into the fund's strategy. The fund is also heavily invested in relatively stable investments like US Treasury bonds and investment-grade corporate bonds, which generally carry less risk than high yield or equities. However, the fund's strategy of investing in clause-collateralized loan obligations carries its own set of risks, especially concerning CLO manager performance and regulatory changes. The expense ratio, or the cost of managing the fund at 1.50%, while typical for an actively managed fund, eats into returns. When you combine this with underperformance, it is a double whammy for investors. The fact that this is an amended filing correcting an auditor's report date, while not a red flag, does indicate a need for meticulous attention to detail. It is not a significant issue in itself, but it does mean they are being extra careful with their reporting. In conclusion, the N-Field Dynamic Fixed Income ETF faces headwinds. While it aims for total return and capital preservation, its recent performance has been under par. The strong investor inflows this past year are a curious point, possibly driven by a perceived safety in fixed income during market volatility, despite the fund's struggles. Investors should be aware of the concentrated nature of its holdings and the inherent risks within its chosen fixed income sectors, particularly CLOs. For those seeking robust returns, this fund might not be the top contender right now, but for those prioritizing capital preservation and a fixed income focus, albeit one that has struggled to outperform. Alright, that is our deep dive into the N-Field Dynamic Fixed Income ETF's latest filing. What are your thoughts on its performance and strategy? Let us know in the comments below. If you found this breakdown valuable, please give it a thumbs up and subscribe for more corporate insights. And don't forget to join our Discord community, linked in the description, for more discussions. Thanks for watching, and we'll see you in the next episode.